Good afternoon and welcome to India Ratings webinar to discuss the road ahead for public sector banks. This webinar will focus on India Ratings estimate on capital requirement with a perspective of bailout capital versus growth capital, post AQR landscape to assess the likely slippages and credit costs going forward, and the rating drivers and triggers for PSBs including their AT1 bonds. Abhishek Bhattacharya, Director Financial Institutions, and Udit Kariwala, Analyst Financial Institutions, would be addressing this webinar today. We'll be taking you through the presentation for the next 20 minutes and then we will open to questions post that. You can type in your questions at the webinar control panel. Alternatively, you can email your questions at investor.services@indiaratings.co.in. The report on PSBs is attached as a handout for your reference. With this, I'll hand over this webinar to Abhishek.
Hi, thank you, Archana, and welcome everybody. So just to give a quick background, we are in the process of reviewing a lot of public sector banks. We have reviewed quite a few, and this is just to give an sort of an interim update on our outlook for these these particular segment of banks in light of what has happened over the last 2 quarters, but more focusing on what is likely to be ahead over the next 1.5 years for them. So moving on in terms of a broad theme in the entire landscape, what we are seeing here is clearly the pressures on public sector banks remain fairly high, both in terms of asset quality issues, the crunch capital situation, and on top of that, there are of course pressures even on the margin front, despite the recent clawbacks allowed on LCR. Definitely we do see that from all angles public sector banks continue to be under pressure. What it does is, of course, overall as a sectoral thematic, we expect a lot of opportunities for the non-banking intermediaries in the next 2 to 3 years, which we are already seeing a lot of traction there. So just in that context, I'll straight away move to the asset quality piece, or on how the entire PSU landscape or the banking landscape looks post AQR. So just to give you a sense of this, the chart in front of you, overall we did a exhaustive bottom-up estimate looking at about 18,000 corporates and looking at various filters like interest coverage less than 1.5 times, debt to equity more than 2.5 times, debt to EBITDA ratio more than 5 times, and wherever listed market cap to debt less than 10%, those sort of ratios. And we see that about 20% of entire bank credit in form of loans by these corporate and SME segments appear to be deeply stressed. Of that, about 10.6% have got some sort of recognition as either NPAs or as standard restructured till at least March 16. Now, what happened in AQR is that a large chunk of loans, there were basically twofold action. One is a big proportion of loans shifted from standard restructured to NPA, attracting higher provisioning as well as classification into, in many cases, buckets like doubtful 1 and doubtful 2 buckets. So the shift you can see is about, in our estimate, about 2.3% shifted from standard to NPA, and the outstanding looks as it is in front of you today. But what remains is still about 8-9% where the stress which are less provided. Within that, about 1.5% have been identified under 525 and have been the banks have taken a bit of prudent provisioning up to say 15% on some of these loans. So they do have a bit of provisioning. About 1% would be to some of the large stress PSUs, not including the SCBs, but the other public sector entities, some of which are still stressed. But what remains is about 6.5-7% of stressed assets, where we do expect, which will keep the pressure on all the headline ratios and slippages going forward. But if you look at the breakdown, we see that almost bulk of it now belongs to the infrastructure sector. So the positive side to this is that most of the deeply cyclical stress like iron and steel and some of the big names associated with that, they have seen some or the other sort of provisioning under AQR. So what remains largely belongs to infra space. A bit of few cyclicals are there as well. But the point I'm making here is now with a few more enabling mechanisms being proposed by RBI like the S4A, some of these loans would tend to get addressed or resolved over a slightly longer time period, and the headline impact might not be as pronounced as we saw in the last fiscal. So if we break down that 6.5%, about 2% is what we expect will continue to flow towards standard restructured book, almost entirely from the infrastructure book. About 3% is already in some sort of talks in terms of either an asset sale or some action happening on the joint lenders forum, or some of them have made the cut on the S4A. I think there are hardly very few names there, but these are some of the names. Our sense is it will make up about 3%. So there would be another 1.5% which we expect will slip. This number would be much lower compared to what happened in FY16. So while on fresh slippages, the credit cost impact could be lower, but the bigger worry is the impact of NPL aging. And that is what we come to in the next chart. As you would look at this slide, I think what we are saying here is the entire D1 and D2 buckets have seen a huge jump just post AQR, because a lot of these loans have directly got recognition from the date of restructuring, and from just being a standard restructured have directly moved to either a D1 or in some cases even D2 buckets. If you look at the bottom chart, that will give you a perspective of in terms of a cross bucket movements, what has happened, and you can see a large chunk in FY16 has moved to D1 and D2, about 2.3 trillion in D1 and about 1.5 trillion in D2, which is way higher than the usual run rate over the years. So what it does is, while going into FY17, we expect that a big portion of credit cost will come from these bucket movements. So while in FY16 we had an exceptional year and public sector banks had an NPL ratio which was as high as, the credit cost was very high at about 280 bips. We expect this will drop to somewhere around 170, 180 bips. Still fairly high compared to say a 5-6 year median of 110, 120 bips for these banks. So ROAs will continue to be under pressure. And the one part which again is not addressed is the non-funded exposure to some of these stress corporates, even in sectors like iron and steel. In many cases, these are things like export performance driven guarantees. In some cases, these are SBLCs, which in a few cases, definitely we see there is a high risk of devolvement. So there would be some pressure which will continue to be there on the P&L on account of these credit costs. But the point we are making also is that it won't be as high as FY16. So in terms of the ratio trends, I think some of these are in front of you. Gross NPA around flattening at about maybe 10, 10.2%. Net NPA also moving up at about 6%. The good part is top 20 exposure to equity, which reflects the overall concentration risk, has been coming down over the years. And thanks to also some of the ACBs now getting categorized and Udaya bonds taking out some of them. But I think still fairly the stress remains elevated, and while ROAs will pick up a bit, as you can see in these charts, we still think, I think they'll be at the bare minimum for the public sector banks. To give you some more flavor sectorally, as I talked about those key filters, this is just to give a sense of what these deeply stressed sectors look like. So they are mostly infra, construction, iron and steel, power. These charts give you a sense of where the median debt to equity and interest coverage ratios lie, or say a market cap to debt ratios lie. Would be slightly dated, about I think a 6 to 12 month, but still it will be fairly representative as to where these sectors stack up. Now, to put this in perspective, the sectoral flavor is while a lot of recognition has happened under AQR, last year in August we had put out a report looking at about a potential 1 trillion haircut which could be there in these large levered corporates. The premise was that even if you take out take up their capacity utilization to maybe the peak or the optimum levels seen over the last 10 years, still there would be an inherent viability gap. And even at that capacity and those blue sky operating EBITDAs, assuming they were to service debt at 1.5 times coverage, still the kind of debt they will be able to sustain would be about 20-23% lower than the debt they are sitting on. So the number we had come out with was about 1 trillion. What we see post AQR is that because of the provisioning in some of these accounts and some of them getting recognized as moving from standard restructured to directly doubtful categories, some of those haircuts have already happened. But still, I think our assessment is 0.6, 0.7 trillion in additional viability gap still remains. Or if I have to express it in terms of CET ratio, last time we spoke about 1.7% could be the potential haircut. I think about 1% of that has happened. Maybe 0.6, 0.7% still remains. The way we look at it is while some of the enabling mechanisms like S4A would start making sense once some of these macro picks up a bit over the next 1.5 to 2 years, and the overall haircut starts looking better than the 50% number which we have today. Because honestly, we feel very few accounts, given today's cash flow visibility, would even be eligible for an S4A, even at a 50% sort of a haircut structure. But the point here is the mechanism is now in place, and over next 2-3 years, we might see a lot of the resolution happening more from a going concern perspective. So the point we are making is even in that scenario, the sort of gap would be something like 60 to 70 bps, which we build as our capital requirement buffer for these public sector banks. Just moving on to the gone concern perspective, or what traditionally we look at from our stress test, is if we take a static portfolio snapshot across sectors and stress it for our estimated a stress case, a probability of default and loss given default, what is the equity erosion? And the sense we get is while in our stress case scenario, maybe 7-8 banks fall below the base, the 5.5% CET threshold, the cost of restoring them back to 5.5 is a manageable number. Our assessment is this will be somewhere between 8,500 to 10,000 crores, which is still compared to including the current tranche under Indradhanush, it will still be 20-30% of that number. So the sense we have is that the bailout capital remains available and the bailout cost is still manageable. When we say bailout, we mean just enough capital to avoid breaching the point of non-viability triggers. The implication is that our support floor for public sector banks remains intact. We haven't taken it down because we still feel that the possibility of PONV triggers approaching remains remote. And the current allocation of the Indradhanush for this fiscal also sort of vindicates our view that most of this capital flowing in is in the nature of a bailout capital rather than growth capital. So that's the point we are making here. Now coming to the growth capital situation, if we look at whatever the current visibility we have, definitely growth appears to be constrained. Now we have again taken a slightly different approach in this report. Typically we used to look at more a top-down credit growth for the system, which would have come from the nominal GDP estimates which we would have. But this time we did a more a bottom-up analysis of what could be actually a growth which these PSBs are aspiring for. And this growth is now just the bare minimum growth needed to absorb their credit costs and the operating costs over the next 2 to 3 years. So what we have now, we are looking at is a growth rate which will generate just enough spreads to absorb these costs and keep their ROAs at their median 7-8 years ratio, which in even in a best case scenario is somewhere around 50-60 bips. So the point we are making here is that this is the more realistic look at public sector bank, how they are approaching growth today. Because honestly, the sense we also have from our rigorous interaction with most of these PSUs over the last 2 months is that definitely they are looking to consolidate profit, grow in risk light segments, and definitely don't have any top line targets. So the blended number we have now is in front of you. We are looking at about 9% blended CAGR over next 3 years for this public sector bank based on this analysis. While an SBI or a few large PSUs may continue to grow in double digits, the smaller or mid-sized PSBs definitely are witnessing a shrinkage. In some cases, it could be even be a loan book decline. So blended basis, we are looking at about an 8% growth for the mid-sized PSUs, and the stack up is there in front of you. For some of the smaller names, it's as low as 5-6% growth. So that's the situation we have. On that premise, our growth requirement or the Tier 1 capital requirement has also come down from our earlier estimates, because that, as I said, those were premised more on a nominal GDP and say a 13.5% risk weight CAGR, but now we are talking about 8-9% sort of a growth. But still at this growth, the capital requirement remains high. It's about 1.1 trillion. Now this doesn't factor in all the future tranches under Indradhanush. So this is in addition to that, the tier 1 requirement which these banks need. And some of the assumptions are given in front of you, what we have built in. 50 bips buffer, CCB, DSIB buffers are included. So the point here is, now if you look in context of this capital requirement, as a percentage of their FY16 CET base, we are still talking in excess of 30% dilution for most of the mid-sized PSUs. When you look at the top chart, the first bar for any rating category, the size of that bar is the amount of dilution on CET1 base as of FY16. What the second bar tells you is that what percentage can government infusion help, and of course the black portion is how much non-core asset sale could help for some of them. The sense we have is, while the large AAA sort of PSUs might manage the capital requirement at this reduced growth, the mid-size would still need to depend heavily on the capital markets. And some of the stacking is given in the bottom chart, which gives you a more bank-wise flavor. And again, these growth rates at which this capital have been assumed, these are all our estimates on the premise that this is the bare minimum growth needed to absorb the likely credit cost and OPEX. Just moving on to, in this context, how do we look at, I talked earlier about the bailout capital and our support floor and the implication for that. But when we look at something like a hybrid instruments like an AT1 bond, what we are saying here is that definitely we do see a heightened risk of coupon deferral this time for some of the public sector banks. While our recent interaction with the regulator indicates that whatever support possible would be extended in to avoid such a situation. But I think for some of these banks, as you can see, the top chart tells you the way we measure as, given their free and available reserves, how many years of AT1 coupon can they service. And there are quite a few banks which drop below the 10-year threshold. Actually, there are a few which are below a 5-year threshold as well, which is where the first call option issuer call can be exercised. So clearly, we do see risk of deferral for a few of these instruments. But the point here also is that a lot of them have managed it well through a lot of technical forbearances as well. Overall, at a median category, you have average coupon servicing comfortable for some of the larger banks. Here, I would like to just make a separate point on the way we look at our rating on AT1. It is slightly more objective compared to just notching from an IDR or notching from the legacy tier 2. What we do here is we look at three separate criterias or three separate notching criterias. One is, of course, the discretionary element of these coupons, that a bank can at their discretion miss a coupon. It won't be a default event. The other criteria is, of course, the risk of write down or a temporary principal write down. That we measure, as I said in the previous chart, which we talked about, what is the quantum of capital needed to maintain those CET triggers, and how much of that can they really recoup through whatever means available to them. So it's a relative notching. The third is the risk of coupon deferral, which is more a reflection of their free reserves available with them and our sense of their profitability trajectory going forward. This is where again some of the banks in this slide on the top chart on the extreme right would attract a notching because they simply don't have visibility on coupon servicing. But you will see a huge I mean the basket wood is wide in terms of our rating across 81 categories, because we would tend to look at banks who have created healthy retained earnings over the years, like say a syndicate bank which has delivered 18% ROE over last 5 years prior to this year, and having fairly high revenue reserves as a portion of their risk-weighted assets. Some of those we do expect would have a higher ability to service 81, and some of that does reflect in our rating on these bonds. Moving on to a little bit look on the demand side, because we are talking about the credit supply and the fact that only 9% is something, given the current capital, is the visibility. But this is a sense which our corporate credit and market research team has put out. They recently also came out with a report on the refinancing requirement of the corporates. Just to give you some sense, the nomenclature in terms of the top chart, it's basically high ease of refinancing, medium ease of refinancing, and elevated risk of refinancing. So the top chart, the top right chart, gives you a sense that while more than half of the outstanding borrowing is from corporates who are relatively better placed and have a higher ease of refinancing, but when you come to the bottom chart, the most of the requirement in next immediate requirement is coming from the distressed sectors, from stressed corporates and from sectors which have elevated risk of refinancing. So the point essentially we are making here is, in FY17, beyond the refinancing requirement, there is very little appetite for fresh credit. So while this year the kind of supply and demand numbers might sort of match up, where we will start seeing an impact is maybe moving into FY18 and 19, when there could be a little bit of uptake in capex, and the banks still might not be in a position to supply that. But for FY17, the way we look at it is most of the requirement is in the nature of refinancing, and that too from some of the distressed corporates. This chart, this slide also gives you a better sense on the overall change in mix of bank lending to the corporate sector. As you can see, banks have also been becoming more risk averse, and the proportion of elevated risk of refinancing, which is ERR in this chart, and stress corporates, their proportion has been coming down a bit over the last couple of years. So clearly the appetite remains low. On the other side, even when we look at the better corporates like HER, high ease of refinancing, or medium ease of refinancing, their supply in the market and the kind of paper they are floating also is facing some challenges with the kind of supply which has come from the Uday bonds. And our sense is that that could dampen the demand for even their paper. So that's just to give some flavor from the demand side on this. Moving on to maybe just the last few slides on the funding side for these public sector banks. As you can see in the top chart, the funding gaps for government banks remains elevated. The gap between your short-term funding gap to total asset for public sector bank has kept high, while the private sector banks have brought it down thanks to their market share gains in CASA deposits over the years and expansion of franchise in the hinterland, getting them access to more granular retail liabilities. This is one key reason why public sector banks continue to lose on the funding side, and their gaps remain high. And the bottom chart actually is a more telling reflection of the chart here is actually up to a 1 year bucket. What is the cumulative outflows minus inflows as a percentage of assets, and a positive gaps mean a higher mismatch. Then the banks shaded in red are the ones which have relatively higher ALM gaps. This is all based on, of course, March 16 snapshot, and some of it definitely tends to be dynamic. But the point here is a lot of these banks have a gap which is higher than even the liquid collateral, and so these banks would continue to see pressure in transmitting any sort of monetary easing. They'll need to pay a little bit of premium on the overnight market, as well as on the negotiated deposit rates. and hence there would be implication on cost of funding for some of them. And in the new MCLR regime, we see that some of these banks are facing issues, finding it difficult to be competitive as well. While one thing which a reduced growth could do for some of these mid-sized public sector banks which are on extreme right is that it would give them an opportunity to cut down on the bulk deposits, get some more relief on the cost of funding, and a lower asset growth means that maybe some of them could see an improvement in their ALM situation. But the one piece which again could be an issue is that with every passing year, LCR compliance becomes more stringent. While RBI has allowed higher clawback now, but we also have to keep in mind that even the reporting requirements will move from annual to quarterly to even at a daily basis a few years down the line if that is implemented. The bottom chart gives you a sense that for an LCR purpose, this is again picked up from the annual reports of these banks, the portion of stable deposits is very low for a lot of the public sector banks which do have a good retail franchise. The point I'm making here is that a lot of them still need to get that MIS in place to capture the core portion of their deposits, and unless they do that, they will have to keep higher HQLA and might still struggle struggle on the ROA front just because they don't have the systems in place to track how much of stable or less stable deposits they have. With that, I'll just close my presentation and open it up for questions.
Thank you, Abhishek. We will now begin the Q&A session. Participants are requested to type in their questions at the webinar control panel. Participants are requested to type in their questions at the webinar control panel. The first question is from Charu. Could you please inform about percentage of fresh NPA due to slippage from restructured assets? What are the fresh restructured assets across PSUs?
Hi, yeah, thank you for the question. I'll just take you back to the slide we had on that entire asset post AQR, the landscape. The point we are making here is that we expect the slippage ratio would come down to something about 1.5% for this year. This does build in the fact the amount which will be basically fresh slippages from the unrecognized piece. So to give you a perspective, if we are talking about 180 bips of credit costs in FY17, about 120, 130 bips could very well be from just the aging perspective. About 40 to 50 bips could be the impact of potential slippages which would be fresh in this year.
The next question is from Vikas. Of all the 81 requirement till FY19, how much is the expected number in FY17? And also which banks may require higher amount of 81 in FY17?
Right. So thank you. Again, I'll maybe just refer to one of these slides here to answer this question. As you can see, so our overall expectation over next 3 years is about 710 billion in 81, and it's a little bit for this year itself. The amount is closer to 200-250 billion of this, and as this bottom chart will give you a sense, the ones with a higher red bar. So some of the banks which do need a high amount of AT1 are banks like SEN, IDBI, BOI, and Canara, Corporation, Union. Some of these, even an IOB would need a substantial amount of AT1. So the bottom chart actually would give you a color on what is the relative requirement of AT1.
The next question is from Gaurav. The question is, what would be the impact of MCLR regime on ROA of banks, and what would be the delta in capital requirement for the same going ahead? Also, what would be the impact of phase out of Basel II instruments in terms of incremental capital requirement for PSBs?
So let me address the second part of this question first. Our sense is from the legacy upper tier 2 and perpetual instruments, it's only on a blended basis about 15 to 20 bips of tier 1 which is there, which would see a phase out over the next 1.5-2 years. Some of the banks have already started exercising the call options, and I think would continue to do so. The first part is the impact of MCLR on ROA. We have definitely seen a bit of impact on margins already. We do, as I mentioned on the chart on funding gap, while MCLR does ease transmission compared to base rate, but the problem here is a lot of them are struggling on the liability side, losing granular retail CASA, and hence they are still continue to run huge ALM gaps. We definitely don't see a huge improvement in an ROA from that perspective, because I think definitely at the best it could be a little bit ROA dilutive for some of these banks.
The next question is from Puneet. The question is, while the AT1 requirement are high, do you think the market acceptance of this instrument is there in the current scenario? Since it will be challenging to raise AT1 capital, what other options the banks have?
Yeah, no, it's a very fair question. In our estimate also, the development of AT1 appetite remains a critical piece to maintaining or managing the growth aspirations or the growth requirements of these banks. The issue which we have here is there are a few regulatory hurdles, and there is a AA cap by a few regulators, and some investors can't really invest below the AA rated paper, which has of course shuts out the market for I think about 80-85% of the paper which is likely to be out. The second of course also is a issue with price discovery. While I think we have seen prices getting the spreads sort of taking into factor the kind of illiquidity premium or the fact that there is no an active secondary market for some of these paper. But I think even from a issuer perspective, the recognition is increasing that these papers, the spread needs to be looked at in context of a cost of equity and not maybe a cost of debt. So we do see maybe a little bit of convergence happening. The other hope we have is that post AQR, there definitely has been an amount of cleanup, and the visibility on the earnings or their ability to service coupon, in our opinion, has increased a bit, while this would have also led to a few rating downgrades and a negative outlook on some of these are more to do with the next few quarters profitability trajectory because a lot of them which are running a negative revenue reserve would need to at least shore up profitability to give comfort on the payment. But overall, I would say there are still fair amount of banks who have a huge revenue reserve to dip into, and who I think are giving a better, you could say, while subdued, but a more stable earnings trajectory going forward, which should encourage investors to look at it at an appropriate pricing. One more related question, of course, also is that on the call options related to these AT1 instruments. Now, this is again an interesting question, and definitely a critical factor. While I think most of the issuances happened starting from last fiscal, and we are still maybe 3.5 years away before the first 5-year issuer call starts to get exercised. But the one key condition this time is that AT1 can be replaced only if it's supplanted by equal or better capital, which would mean they need to shore up profitability or retained earnings to cover up the CET ratios. As I said, I think at the current capital visibility doesn't give us that kind of a comfort, unlike an upper tier 2 or the legacy bonds where an RBI approval could be enough for redemption. This time definitely it has to be driven more from their own ability to generate retained earnings. While that alignment has slightly, I mean, it's the banks of, you could say, focus is moving in that direction. I think we are still a little bit away, but 3 years is still a fair bit of horizon, and by that time the Basel III milestones, I mean the March 19 compliance would have kicked in. So either some amount of capital would come in, or some amount of growth rationing would have happened to offer comfort. So at this point, I think that's the point we can make. But the other point also we would make is that our AT1 ratings reflect closely the standalone profile of the banks, and they are the entire notching which I spoke about earlier. The benchmark for them is the standalone profile for the banks. So for some issuers, even from an IDR, we would have a 5-6 notches difference as well, because it would start from the standalone profile of the bank. The point I'm trying to make here is that should give more comfort in a bank's ability to really shore up that capital, because that is reflected in the way we rate. Another question is, of course, which banks are exposed most to the infra, iron and steel sector? I mean, this just, based on annual report, I mean, if you have to give a proportion, I think these are some of the banks like, say, IDBI, Vijaya, Central. But I think this in the latest Basel statements also, these should be easy to find. There's another interesting question, which is that given huge capital requirement for public sector banks, is it likely that RBI may deviate from Basel III timelines or come out with some kind of dispensation for weaker banks? Now it's a question in the correct context, because even for European CoCo bonds, what we have seen is that what was earlier mandatory have come down to more guidelines for banks in terms of their ability to service coupons. While we don't yet have anything in front of us which would confirm this, but our recent interaction with regulators suggests that they are looking at this AT1 market very closely, and they want this space to be constructive for investors, because it remains critical to the way public sector banks have to manage their growth. And hence, whatever is available within the tenets of Basel III, I think those would be made available to these banks. So definitely do expect support, but yeah, outright whether they will change or deviate from the Basel III timelines, I don't think we are there at the moment. Again, there was a question on whether we have a bifurcation of stressed assets in terms of sectors like retail, SME, housing, mid-corp and large corporate. Again, the point here is I think 80-85% of the stress belongs to the large corporate. And as our earlier chart, I think the point we made was that these sectors which haven't seen any sort of provisioning now, if you look at the top right, it gives you a sector composition that most of it now belongs to sectors like infra, power, telecom, and a small portion to cyclicals in iron and textile. I'm not saying that the pain on cyclicals is totally over because they have seen the initial round of provisioning, but I think the recognition has happened for the cyclical sectors, and now they are part of the bucket movements, and some of the larger accounts will keep seeing higher and higher provision unless some resolution happens. There was another question on whether we expect any risk on the PONV